This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Types of assignment. The first types of assignment we're going to look at are known as assurance engagements or assurance assignments. And in these assignments, the auditor or the accountant is giving some sort of opinion on, for example, the financial statements. Now, there will be two potential types of assurance assignment. First of all, the auditor or accountant will be willing to give positive assurance. In other words, the auditor will say the financial statements, in the auditor's opinion, show a true and fair view, but it's a very kind of positive statement. I think this is the case. This positive assurance is also known as reasonable assurance because, as you know, in the audit report, no auditor is going to say for sure the financial statements are correct. They're saying, to a reasonable certainty, to a reasonable probability, the financial statements are free from material misstatement. So it's not a guarantee, it's reasonable assurance. So on historical information, where you're looking back, the common one we'll be dealing with throughout this syllabus is, of course, the positive assurance given on financial statements as a result of an audit. The financial statements show a true and fair view. Or alternatively, of course, except for not making sufficient allowance for bad debts, maybe they don't show a true and fair view, or whatever opinion the auditor comes to. Some historical information, however, we might only be asked or be required to give what's called a negative assurance or limited assurance. Now, don't think that this word negative means that the accountant or auditor is saying that there's something wrong with what they are reporting on. It's not saying that the financial statements should be qualified or changed or anything of that sort. It's a more technical term here. It is simply saying we haven't found anything to make us think that there's a problem. And therefore it's much more limited. So negative and limited go together. It's much more limited than the positive or reasonable assurance. And an example of where you're going to have a negative or limited assurance assignment is where you're not asked to do an audit of the financial statements, but maybe to do a review of the interim financial information which is released, say, 6 months through a year, perhaps for limited companies, for listed companies. So the auditor has a look at the financial statements. The auditor tries to make sure that they make sense, if you like, and that there's nothing which has obviously come to light that would make the accountant or auditor think that there's something wrong with the information which is being presented. Now, both audits and reviews here were historical information, but sometimes accountants are asked to give assurance about information which is other than historical. For example, prospective financial information, basically budgets and cash flows that a company might want the accountant to look at and kind of sign them off and then send them to the bank, perhaps to support applications for loans and overdrafts and the like. So we're looking at the future, but we're still giving some sort of opinion, and I think you'll understand that it would be extremely rash if an accountant were to say the budgets for the next 3 years show a true and fair view. If you want to kind of put it like that, how can you possibly judge? You're almost saying that the budgets are right. All you can really do is to say, I've looked at the assumptions, I've looked at the calculations, there is nothing which is obviously outrageous about those, and therefore you can give this limited assurance. Another example is due diligence. And again, all of these you'll see somewhere else in the notes. It's set out in the notes, the other chapters to refer to. Due diligence happens where typically one company is taking over another company, and they want to know, what am I buying? What's in this company? Because the financial statements only show a relatively limited amount of information about what's in the company. It's not going to be saying anything about, directors' contracts. It's not going to be saying anything about leases that the company might be in and difficult to get out. So what basically you do is you go through and you almost look at every contract, almost every bit of documentation in the company, and you are giving some sort of assurance report, really, that the company that we're thinking of taking over, there are no kind of skeletons in the cupboard, there are no horror stories. But of course, again, this is often done in a rush. You take an awful lot of work to be able to give positive assurance about that, and that's also going to be negative assurance. And then we have here, when a company is issuing a prospectus to raise capital from the public, there are certain reports which have to be prepared by management, and there are also a certain type of assurance which is set out in your notes, certain type of assurance, which again would be limited assurance, which the accountant or auditor would basically attach to the prospectus. Other types of assignment, now we're getting away from assurance assignments, we're not giving our opinion anymore. First of all, agreed upon procedures, called agreed upon procedures because the auditor and the client agree on what work the auditor is going to do. The auditor performs the work and then will normally submit some sort of answer, some sort of report based on the work that's been done and evidence found. Examples here, if a client discovers that a fraud has been going on, the client will probably want to know, how did it happen, how long has it been going on, who's been involved, how much did we lose, and the accountant go in as essentially wearing a kind of forensic hat and can give a report on those areas of the fraud. Another example could be an insurance claim. The warehouse burns down, there's been inventory in the warehouse. The insurance company wants some sort of report which assesses how much inventory was lost in the fire and therefore how much compensation the company may be entitled to. And again, the accountant will do work agreed with the client to assess the inventory that was lost or damaged in the fire. And finally, there is a compilation engagement. Basically here the accountant is helping the client in the production, the preparation, production and so on, typically of, say, financial information. We know, of course, that if you are preparing financial information, you shouldn't also audit it. But in some cases, particularly on listed companies, where you have a good division between the accountant and the auditors, it is permissible, with safeguards, for the auditor, or at least a separate section, the auditor's firm, to compile or prepare the financial statements.